Good evening and welcome to week 2 of our multifamily masterclass. In week 1, we talked about the why. So I hope this week you meditated on that why and thought about it, and kind of everybody's why is personal. So I hope you thought about that. And now we're getting into the how. So everything from here on out until we make a little bit of a return during a mindset session is about the how. So I'm going to go right into it. Thank you for being here. We're looking very forward to getting this information out to you. And this will be detailed information starting this evening on how to invest in multifamily apartments. So give me just a moment here. I'm going to share my screen and we'll get right into it. Okay, everyone should see these slides on your screen. And this is week 2. We're going to get right into it. First of all, I've got to do a little bit of a disclaimer. So this presentation includes educational documents, and this is for educational purposes only. Nothing in this presentation or documents contains legal, tax, financial, or any other type of advice. All investors should consult their own financial, tax, legal, and other professional advisors to determine if investments are suitable for their unique situation. All investments have risk. Make sure you understand the risk profile before investing. Anyone viewing this presentation or documents should be completed their own due diligence based on their own interest, preferences, assumptions, assessment, and risk tolerance. We're not guaranteeing investment results or outcomes related to real estate investing. And this document contains information from sources that are believed to be reliable, but we can't guarantee the veracity of their claims or their continued veracity in the future. Financial projections in this document are believed to be reasonable, but they're based on assumptions, hypotheticals, and estimates. And nothing in this document has been reviewed for or approved by the Securities Exchange Commission. We're going to talk about the SEC here as we go forward tonight in this presentation. So what are we going to cover tonight? Just these are the main things, the highlights. We're going to look at the ingredients of a successful deal. It's really important to understand everything that has to happen to make a deal successful. We're going to go through syndication terminology. This is really important to know these terms. So when you're dealing with syndicators, sponsors, you're at a conference, you can talk the talk and you can feel like you're speaking intelligently about these offerings, about these investments. The first time I went to a big real estate conference, I felt like everybody was speaking a foreign language that I didn't understand, even though I had been in real estate for 20 years on the single family side. So in learning these terms, what they mean, and being fluent in the language that people speak in commercial real estate is very important. So you're not intimidated and you can ask good questions. We're going to talk about some basic securities law. I'm not an attorney. I'm not giving anyone legal advice. I'm just going to tell you what I know from what I've learned so far about the basic security laws that govern what we do. And I encourage people to get legal advice on their own from a real attorney if they feel like they need that before making decisions on investments. Deal structures and fees. How are deals structured typically? What are the different structures? Advantages and disadvantages. What does a typical fee structure look like? And some red flags on fees. And then the typical investment process. For those of you that are worried about doing a lot of math, I got good news. There's no math tonight. So we're just covering stuff that's non-mathematics. We will get into calculations and mathematics and some underwriting next week. So if you're really hungry to get your calculators out, we'll be doing that in the future, but tonight is no math. It's just basic educational information. So let's talk first of all about the 3 ingredients for a successful real estate deal. And this is the 3 ingredients I'm going to talk about are needed in every single deal, whether you're doing single family, multifamily, any kind of commercial, you're doing a flip, you're doing rentals, it doesn't matter. These are 3 things that every deal has to have. So first of all, it has to have time and effort. Somebody has to do the work. So time has to be spent, effort has to be made, and someone has to go out and do that work. So there's a lot of work. There's hard work that goes into every real estate deal that is successful. And whether you're doing or somebody else is doing it, someone has to do it. And when we do passive investing, we have somebody else do the work. So it's important, and someone else is spending the majority of their time. The whole idea of passive investing is to free your time up, to give you time freedom. Expertise, making the right decisions. This is probably in some ways the most important thing. You can be a hustler. You can be out working hard. You can work yourself into an early grave. But if you're making all the wrong decisions because you don't have experience or expertise in the field you're working in, you're going to make the wrong decisions, and all the time and effort spent is going to be a waste. So when we do a passive investment or real estate syndication, we're hiring expertise. We're betting on the jockey, not the horse, not the property. We're betting on the team. So expertise is supremely important, so the right decisions are made and the investment goes in the right direction and we get good results. And then finally is money. Debt and equity, both are money. If you talk to anyone that's been in real estate a long time, they look at debt and equity exactly the same. They don't really see any difference in the two things. It's just the source is different. So obviously debt comes from a bank. It could be from a private lender. It's paid back on a schedule. And then equity would be like your down payment. It'd be your reserves. It'd be money that you raise. It would be money from investors. Okay. So when you do a passive investment, which of these do passive investors provide? Do they provide time and effort? No. Expertise? No. You're not going to be consulted as an LP on what decisions to make. You're not really making the decisions. And you're not going to be signing on the loan or loaning people money. You're not providing debt. You're really providing equity only. Number 3, equity only, no debt. You're not signing on a loan. You're not a bank. And you're providing the equity for the property. The expertise is the team, and it's their time and effort, or their employees' time and effort, that's going to hopefully get you to a successful result. So when you look at a deal, always think about these 3 things. And if you're going to go out and do deals on your own, if you're doing it yourself, you got to provide all 3: time, effort. Hopefully you have expertise, you're making the right decisions. And then you've got to go sign for a loan or borrow the money, and you've got to either get the equity somehow borrowed from somebody or put your own money into the deal. Okay, 3 types of deal structures in real estate, and this is all real estate in general. And there, you can probably classify more than 3, and people are really creative, but these are the 3 basics. So the first one is do it yourself, and this is the Lone Ranger. One person doing it. I call them Lone Rangers. Mom and pop. It could be a family. It's one person, or maybe it's a couple or partner, or a husband and wife, or a family that's doing everything. Okay, this is the most labor and work intensive. It could be a labor of love. They could enjoy what they do. This is generally in multifamily. People can look for these deals, and they're definitely the most likely to be mismanaged, because sometimes the people running the property aren't the best managers, or they may have inherited the property. Somebody passed away and they haven't been managing it properly. Okay. This is very common in rentals, flips, things like that. People are doing it with their family or doing it by themselves. Joint venture is the next. And this is a partnership where everyone is active. So everyone is active on the deal. Everyone has things to do. Everyone's providing effort and time. Everyone is providing expertise on the deal. They're all active. And then maybe 1 or 2 people are signing on the loan, but everybody's pitching in the money, the equity they need for the deal. This was kind of very common prior to syndication coming out. There are still people that do this. It can be awesome. It's just on bigger deals, it's hard to find people that can put millions of dollars each into a deal. And when you have a partnership, sometimes they go sour. And with everyone participating, sometimes you have too many chiefs and not enough Indians. So I've been warned about partnerships. It sounds like it could be a great thing, but I know people that are in partnerships that are very unhappy. And you've got to be very careful, I think, about going active with people long-term in these deals. And generally on a bigger deal, you can't raise enough money with just a partnership with no outside investors. But this structure was very, very common before 2012, and it became less common as syndication became more of a thing. Which brings us to our last one, which is syndication. This is active partners. Sometimes called general partners. We'll talk about that in a minute. These are active partners managing the deal, and there's passive investors that are not involved in the management. They're just providing the equity. They're just providing money on the deal. This is probably the most common structure on bigger deals. In fact, I know it's the standard basically as far as structure. So what's a real estate syndication? I had been in real estate about 20 years when I started looking at commercial real estate, multifamily. And the first time someone brought up syndication, I had no idea what it was. I thought they were talking about making a movie, someone in the mafia. I mean, I didn't know what a syndication was. I honestly didn't know it. So it's something that's very particular to commercial real estate. So the definition of a real estate syndication is when multiple investors pull their capital to invest in a real estate project, which is managed by the sponsor or the sponsor team. So people put their money together, they put their capital together, they put in a real estate project. It's managed by a sponsor or sponsors or a team. And this allows the investor and sponsor to access larger or more complex deals than either one can buy or manage on their own. So if you're a person that's bringing $50,000 to a deal and you don't have a lot of experience and you've not signed on a big loan, you can't go out and buy a $20 million apartment complex, okay? You've got to have someone with expertise, someone with net worth to sign on a loan, somebody that can manage the property. On the other side of the coin, the sponsor can't come up with all the money on their own without the investor. So this is a very symbiotic relationship. If you're doing that $50 million deal and you got to raise $15 million, you can't do it with a joint venture typically. So the sponsor needs the investor needs the sponsor. It's a very, hopefully, cooperative and mutually beneficial relationship. So everybody can go out and they can take down a deal that they could not buy or could not manage on their own. And the whole idea is putting people together, teamwork, investors, sponsors, having amazing teams, having investors involved, and going out and doing deals that no one could do on their own. So that's basically how real estate syndication works, if you didn't exactly understand the definition, the technical definition. Okay, syndication key terms. I'm going to go through a real quick glossary of terms, and then we're going to go through some of these terms in more detail in future slides. This is kind of the general language when you're talking about deals, except for some of the numbers, which we're going to go into that next week. These are just basic terms. So first thing is limited partners. These are commonly called LPs. When you hear a limited partner, LP, just think investors. Most people that are sponsors or syndicators or capital raisers, they'll just say LPs. Sometimes they'll say investors. So when you hear LP, think investor. The next thing is the general partners. These are general partners that are actively managing the deal. They're signing on the loan. They're providing the expertise. They're raising the money. They're providing the time, effort, and expertise. They also should be investing in the deal themselves. We'll talk about that. General partners are also called sponsors or syndicators. I hear sponsor and GP a lot more. Basically, so here GP, general partner, sponsor, syndicator, all those terms are kind of, they're all the same thing, basically. Private placement memorandum, okay? This is the legal document that you sign when you invest into a private real estate deal that basically tells you about the deal, tells you how the deal is going to be operated, what the rules are, and tells you what the risk involved in the deal to the investor. These are typically very big documents. They're over 100 pages in most cases, and it is something that you need to go through and read on every deal, okay? Private placement memorandum. It's always used in bigger deals. I would say if you're going to invest in a deal like this, it's required. Some smaller deals will do like a joint venture model, and they basically will not do a private placement memorandum, usually because the sponsors are cheap and they don't want to spend $15,000 or $20,000 for the legal work. I would recommend that you only invest in deals that have a private placement memorandum. If you ask about the PPM and they say, we're doing this as a joint venture, and we got somebody that's going to raise money. And that is a way that basically they're trying to skirt the law, in my opinion. I would stay away from it. So I'll put it required. So you run a deal. I'm going to see the private placement memorandum so I can study it. That's what I'm going to sign. They say we don't have one, we're not getting one. I would pass on that deal. That's a major red flag, in my opinion. All professionals use the PPM, protects you, it protects the sponsors, it lays out the laws. On smaller deals, some people try to get around that, but I would stay away from smaller deals, which we will talk about as we move forward on buying into deals. Generally, bigger is better in real estate, and bigger deals are generally safer if you have a great team. Subscription documents. Okay, this includes the private placement memorandum. It includes any kind of documents you sign to get in the deal. It could be the operating agreement. It could be a private placement memorandum. It could be a survey or a questionnaire about your previous investment history to get into the deal. Subscription documents. Private placement memorandum is one of the documents, but generally the subscription documents are what they call everything you're going to sign to get it in the deal or to subscribe to the deal, as some people would say. Pitch deck is basically the investor slides. I hate the term pitch deck. I mean, I was so turned off the first time I heard that. I don't really want to be pitched anything. I really prefer investor slides. So if you're working me in a deal, I'll never call it a pitch deck. I mean, sometimes I'll tell sponsors, hey, I need to see your deck. I mean, I want to see it. But generally, I prefer investor slides. I've also heard the deck referred to as an offering memorandum, but I've also heard the PPM referred to as an offering memorandum. So there could be some confusion depending on who you're talking to, what they call an offering memorandum. I just basically like to call it the investor slides. I'm gonna go over the slides with you. We're gonna go over the deal with you, and I'll send you a copy of the investor slides so you have all the slides. I like that. Pitch deck just sounds like a really annoying term to me. Accredited investor. This is an investor that has met certain financial requirements in order to participate in the deal that they're going to invest in. We're going to go into these requirements on the next slide because it is important. If you're not an accredited investor, you want to strive to become one. And the people that invest with me, if they're not accredited, I want to turn them into accredited investors. We'll talk about that on the next slide. Sophisticated investor. Generally, this refers to someone that's not accredited. So we don't say accredited and not accredited. We say accredited and sophisticated, because if you're doing a private placement and you're not accredited and the private placement allows it, you're supposed to be sophisticated. Okay. So how do we determine if a person is sophisticated? This is generally done in a questionnaire. So it's what kind of investments have you been involved in? You invest in stocks, bonds, REITs. I bought, single families. I've done a private placement before. I've invested in land. In a private placement that uses sophisticated investors, they're supposed to be versed in these type of investments and understand the risk. And you will sign a document asking you those questions. We'll get into that in just a minute on the deals for sophisticated investors. And then finally, a preferred return. A lot of people, the first thing they ask on a deal is what's a preferred return. So preferred return is a return that is going 100% to the LPs or the limited partners, the investors, before the sponsors or syndicators get their cut or get paid. So it's basically, and that part of the return, and it's typical 7 or 8%, but it could be more. If it's too much, it's kind of a red flag, in my opinion. We'll talk about that. But basically, the preferred return goes to the investors. If you have an 8% preferred return, 100% of the return goes to you until that metric is met, and then you start your split. So some people say, what's the preferred return immediately? That's like the most important thing to them. That should not be the most important thing to you in a deal. We're going to talk about that. But if they say preferred return, that's what they're talking about. And we'll explain this in detail a little bit more. So let's go back for a second to accredited investor qualifications. Okay, are you accredited or are you not accredited? And how do we figure it out? So the first way to figure it out is a net worth of greater than $1 million. And this is not including your primary residence. So the $1 million could be savings, it could be stocks, bonds, mutual funds, a brokerage account, IRA, 401k, investment property, securities, money you have in private placements and commercial real estate. It can be anything that adds to your net worth, excluding your primary residence. So in some states, like California is probably a good example, some people have massive amounts of home equity. So what this does is this levels the playing field. So if you're in California and you bought a house years ago and it's worth $3 million and it's paid off, it does not help you. So here's an ironic part of this. So let's say you're on the Dave Ramsey plan and you pay off your house and you have a $500,000 house and you pay it off. Your net worth would be over $1 million. But for the case of this, you could actually put yourself in a situation to where you would not qualify because they would not include your primary residence. So to simplify it, net worth, not including your primary residence and not including your mortgage, assets minus liabilities. And if there's any questions on this, I can explain it in more detail. This is the most common way to qualify for a lot of people. The second, individual income of greater than $200,000. This is based on your W-2 or your most recent tax return if you're an individual. If you're running a business and you got an amazing business taking $1 million deductions, or it's a startup, then you may not have a great income and you might be taking a lot of deductions and may not qualify. It's a little easier sometimes for people that have a W-2. Most people that have real estate wouldn't qualify because they're not paying that much in taxes and it wouldn't show on their adjusted gross income. So they go mainly to the net worth, but individual income greater than 200 does work. Joint with spouse income greater than 300,000. So the way this would work is if you are married, you have a spouse, and that person, let's say you make 180, and let's say they make 130. So together you got 310,000. You're accredited. Okay. So if you have two incomes and they're both less than 200, you can qualify as long as they're both greater than 300. Investment professional, securities dealer. If you have a Series 7, a Series 65, or a Series 82 that's active and you're in good standing, you're in there. You're good. You're good. So this is an exception for people. I don't run into it very often. I've never had people really come to me yet in my career and say, hey, I don't have to prove my net worth. I've got a Series 7 and it's active. I'm a securities dealer. Hasn't happened, but that's an exception. The other exception is a general partner selling securities in the deal. So when a general partner is selling securities in the deal in a 506C, and we'll talk about what that is in a minute, they're considered to be accredited regardless of their net worth, regardless of their income, and we have to verify it. So if I'm raising money in, say, a 506C, and I decide I want to put $50,000 in the deal, the sponsor doesn't have to check my credentials, although I am accredited and my wife's accredited. They don't have to check and see if we are or look at the different ways that they can check that. So how do you check that? How do you verify that? It's generally done as a third-party verification. There's companies like Parallel Markets that do checks for people, and they do a third-party verification for accreditation. You can also get a letter from a CPA or a financial planner that says they're aware your net worth is more than, $1 million, and there you go. Generally, sponsors will not underwrite you. So you can't send your bank statements and stuff to a sponsor or a tax return or a W-2 and get them to verify. They're not underwriting. They want a third party verifying. We'll talk about that on the next one. So let's talk about the Jobs Act of 2012. This is what blew up and kind of created the world of syndication in real estate. So it all goes back to 2012. This really kickstarted the revolution in commercial real estate that we call syndication. Okay, what is the Jobs Act? The Jobs Act was the Jumpstart Our Business Startups, which is the Jobs acronym, Act signed into law on April 5th, 2012, aimed to ease capital raising for small and emerging companies by relaxing some regulatory burdens and facilitating access to capital markets. Jobs Act included a provision directing the SEC to amend Rule 506 of Regulation D and remove the ban on general solicitation and advertising for firms conducting private offerings in reliance on Rule 506. Okay, so that's a lot to absorb. So prior to this, what was happening is you had the corporate scandals in the early 2000s. You had Enron, WorldCom, people remember that. They cracked down on that with a law called Sarbanes-Oxley. If you've ever been in the corporate world in finance or in the Treasury Department, and there's a lot of things with Sarbanes-Oxley, makes it much harder to go public. It's just a regulatory boondoggle for bigger companies. Then we had the financial crisis, which made it much harder for companies to raise money. Everyone's scared out of their wits financially, couldn't raise money. You had Dodd-Frank that came in and put even more regulation on businesses and made it more difficult. And you had the Consumer Financial Protection Bureau. So you've got all these laws piling up, making it more and more difficult, more and more regulation. And in 2012, that's an election year. So the president that was president this time was running for re-election. They were getting feedback from donors, hey, it's hard for us to raise money in Silicon Valley or in the markets, in private placements. This is affecting our business. So they passed a law called the Jumpstart Our Business Startups in an election year to help out with this situation. It was passed and signed. And then basically what happened was it changed all the rules. So it made it easier to raise money, and it codified what led to syndication. So Jobs Act provisions, Regulation D 506B. Okay, there's two of them we're going to talk about, the 506B and 506C, because this pretty much covers syndications. There's other stuff that covers things like crowdfunding and other types of capital raises, but we're gonna talk about B and C. So the important thing to remember about B, to keep them clear or to keep them differentiated, is I always remember 506B as buddy. B is buddy, because it means you know the people that you're dealing with, that you're raising money with and for, or the investors. So just when you hear 506B, automatically think buddy, and that'll be an easy reminder when I go through what the regulations are. So on a 506B, you have unlimited accredited investors. You can raise as much money as you want. You can raise $1 billion if you need to. You can raise $1 million, $1 billion, it doesn't matter. Unlimited accredited investors. I can bring 700 people into a deal if I need that many people to raise the money. There are 35 spots maximum for non-accredited investors, okay? So you can bring in 35 people that are non-accredited. One of the misunderstood things about 506B is if you do a 506B, you don't have to accept non-accredited investors. Almost everyone does, and they have a carve out for 35 people that are non-accredited, but they don't have to. You can have a 506B and they can say everybody's got to be accredited. You can also have a high minimum. So I haven't run into this too much in the deals I do, but you can put $1 million minimum. Or on a 506B deal, a lot of times it's small groups of people that all know each other and they all jump in on the same deals. And it's the same 20 people and they can bring $20 million to a deal just like overnight. And it's all no advertising. And, we'll kind of talk about these are small groups of people. And really 506B is a huge part of the business, but you never know about it unless you know these people because they're not advertising on Facebook. And we'll talk about that in just a minute. So unlimited accredited investors, 35 maximum non-accredited. If you're a B and not accredited person, you want to get on one of these deals, be aware there's only 35 slots. So if it's a big deal, they may fill those up. You get 35 people to put $50,000 or $100,000 in. That's what, like, I think $2 or $3 million, it might fill up and you might not be available. So you have to move a little quicker if you're a non-accredited investor. So be aware of that, but don't be pressured or rushed. All non-accredited investors must be sophisticated. So when you do a questionnaire on a 506B, you're going to put in there, am I sophisticated? What kind of investments have I done? What's my background? and the sponsor is going to look at what you read and they're going to accept you based on that. Um, I've not heard of someone yet not being accepted because of their questionnaire, but technically it could happen. I mean, if you were like, I just won the lottery and I won $500,000. I've never invested in real estate before. I've never bought securities. I don't know what I'm doing. I'm not accredited and I want to put 500,000 in your deal. I've never done anything like this before. A really ethical sponsor would say, hold on, you're not sophisticated, and they wouldn't take the money. So that technically could happen. So that's something to be aware of, but I've never heard of it. I mean, generally your investment's accepted almost always. There's no general solicitation. General solicitation means no advertising, no social media, no marketing. I can't buy ads if I'm doing a 506B. I can't post on social media. I can't even post on social media. I have a deal. Please call me without any specifics. That could lead to a solicitation. I've got a deal. Call me. Can't do that. And then no marketing. I can't buy an email list of people I don't know and start sending out emails. So I'm very limited. But this is a huge part of the business because people that know each other work in these groups, and 506B is very common. The investors also have to have a substantive pre-existing relationship with a sponsor. And this is important. So you've got to know the sponsor before the deal starts, have a pre-existing relationship with them, which means you knew them and you've communicated maybe a couple of times on the phone, on a webinar, you have their email address. The best definition I've heard of this was from someone I know that does 506B deals and they raise a lot of money. And I said, well, how do you define like the relationship? And he said, if I'm in a conference and I run into somebody and they come up and say hi, and I know their first and last name immediately without even thinking about it, that's a 506B. That's someone I have a relationship with. I know who they are. They're a friend, they're a neighbor, they're somebody that I know. But you have to have that relationship with them first. They have to be a sophisticated investor. And the SEC provides guidance on this, and they want a cooling off period. So if you're involved with someone that has 506Bs and you do an introductory call and they have a 506B coming up, or they have one they're raising money for, on the first call, they should always be telling you, we don't have a deal right now. We're waiting for a deal. We don't have a deal. They should not present the deal for 30 days. Okay. The general rule is once a deal starts, you can't bring anybody in. But if you had a long capital raise, you could technically, in my opinion, you could have the deal going. You could meet a new person that qualifies as accredited or one of the 35 non-accredited spots. You could document conversations and emails and that you know this person. You do maybe a webinar with them or Zoom call. You know them, you're in contact with them, you know their financial situation, their needs, and then you take 30 days off the calendar and come back to them and say, hey, we talked 30 days ago, we've gone through a cooling off period, and now I have a deal to present to you. And we've got a deal we've got going, and now you can take a look at this. That would probably be compliant, but I've heard both ways. Some people told me you could do that. Some people said, hey, just wait till the next deal. So that's kind of how our 506B works. Remember, buddy, you have to know them. That's the best way to keep track of it. 506C, Regulation D, accredited investors only. Have to have the $1 million net worth or the income or be a securities dealer or a general partner on the actual deal. Only accredited people. There's no spots for non-accredited. And you do a third-party verification. So you have to verify with a CPA letter, parallel markets, third-party verification service. The letter has to be recent. Parallel markets likes to do them every 90 days. I think that the letters are technically good for 5 years. But if they're older, some sponsors will make you send an email that says, here's my accreditation letter. It's a little bit older, but nothing in my financial situation has changed. It's still valid. Some people will make you go back and get a whole new verification with your third party or a new CPA letter, which could be a hassle. But if you want to do the deal, you just have to go and do that. General solicitation, advertising, social media marketing is allowed. So I can go buy Facebook ads. I'd go on LinkedIn. I can say, I've got a deal. I can do social media. I can do email marketing with the list that I buy. I can do anything that I need to bring someone into the deal, and there's no cooling off period, and there's no substantial relationship required. So I can be at a conference and I meet someone and they say, "Hey, you seem like a great guy. Do you have any deals right now?" And if I'm doing a 506C, I can say, "Are you accredited?" They say yes. Boom. Yes, I have a deal right now. You can look at it right away. Let's go talk about it. I can show it to you. If I'm doing a 506B, I can't do that. So if you're an accredited person, don't think, wow, I can do every deal. Nope, you can't. Even if you're accredited and you're doing a 506B, you have to have a substantial pre-existing relationship with a sponsor. If you meet someone on a 506B and you're accredited and they pitch you a deal immediately, that's a red flag that they're not really following all the security laws. Now, here's something else that some sponsors do is become more popular. You can start out a deal as a 506B. You can do a certain time frame. It's usually 30 days. You can take in your Bs, take in your accredited investors, take your 35 non-accredited investors, and then at a certain date, you can transition to a 506C. So if you're trying to raise a lot of money, you can get it out on the internet at that point. You can advertise social media. You can start marketing. So you can have a 506B that after a period of time can morph into a 506C. However, you can't go the other direction. So you can't go as a 506C in the beginning and go back to a B. I've done one deal that was a 506B, and we signed paperwork, and we were trying to get it in at the very end of the B, and the paperwork didn't get countersigned on the right date by the sponsors because they were busy, and they moved it to a 506C. And we still did the deal. We're accredited, but we had to go back and re-sign our paperwork because the paperwork is different on the 506C. The subscription documents are different. We had to re-sign. So 506B buddy, 506C accredited, know the differences, strive to be accredited. If you're a 506B, realize you need to know the sponsors, you need to get on people's list, you need a network, and you have 35 maximum non-accredited spots. So if you have a deal you like, you need to figure out if you're going to get on the deal or not and get into the deal before the spots fill up. Okay, two key facts about syndications, and these are very, very important. In a syndication, you're not buying real estate. Okay, I know this seems strange to a lot of people. You're buying a security. That's the way the SEC would define it. So you're not buying real estate. You're buying a portion of a company, the real estate, as a security. This is why 1031s and big multifamily syndications are so difficult, because if you're going from one syndication to another and you have securities and you're going to go buy another security, guess what? It's really hard to do a 1031 because you've got to make the 1031 tenants in common on the next deal. So on a 1031 exchange, generally, the sponsors have a huge minimum for that. They're like, hey, we'll do a 1031 if you're 1031ing 400,000, 500,000, some big number, because the sponsors got to go out and pay about $15,000 to make you a tenants in common on their new syndication so you can do the 1031. So some of them have 1031s accepted, but realize that it's going to be a big minimum because you're bringing $50,000 or $100,000. It doesn't make it worth the legal issues and the time to accept your 1031 on a syndication. But you're buying a security. When you buy commercial real estate or buy multifamily, you're buying a business. It's really important. We'll talk about that in underwriting. Keep it in mind. The real estate is just where the business is located. Second thing, buying real estate in a syndication is more like buying a business in a private equity deal than buying a rental property. If you're using an IRA to go and buy into a syndication, and if you're using one of the bigger ones that I use, you go in and they have a wizard for your investments. You can pull money out of your self-directed IRA. And if you click on real estate, you're going down the wrong path. And when you submit your information for your deal to your IRA person that's helping you on the other end, they will reject it and they'll tell you to resubmit it to private equity. How do I know this? Because in the first deal I ever did, I did it wrong, and the IRA company made me resubmit it under private equity. You're doing private equity, you're buying a security, you're not buying real estate. Now, you get a percentage ownership in the real estate business, and the value of that is very dependent on how the real estate performs and how much money it brings in the net operating income. So it's more like buying a business in a private equity deal than buying a rental property. Please keep that in mind. You're buying a security, very important. Okay, three main return structures. This is how the structures generally are. Preferred return, then a split. Investors paid 100% until a certain return is reached, then returns are split. So if there's a preferred return of, say, 8%, the money's given 100% to the investors until, let's say, the 8% is reached, then it's a split. 70-30 is common, okay, on this kind of deal. This favors the investors. If the real estate does poorly, let's say it does 8%, the preferred is 8%, they got to sell the property, the investors make all the money. They could take a haircut if it's less than 8%. Sponsor makes nothing on the back end. Okay, so preferred returns favor the investors in many ways. If the deal goes bad, they get paid first, so their preferred return. This is the most common structure. Investors love preferred returns. They like investing in preferred returns. Hard to raise money without it. The next is a straight split. No preferred return, 80-20 split is typical. I love these deals. They're hard to find. The reason I like them is that you're not given a preferred return, but the interest of the general partners and the limited partners are perfectly aligned. And the accounting is really simple. So if a dollar comes in, 80 cents goes to the investors, 20% goes to the partners, general partners, and there's no preferred. Another thing this means is that the deal is cash flowing immediately for the general partners. See, one thing you got to realize on a preferred return is if there's an 8% preferred, let's say the cash on cash is 7%. Well, if the business plan's proceeding as intended, they're not making the 8%. They're just paying 7%, and the rest is accruing. So the only way the GPs can get their money out of the deal is a sale. So they get 3 or 4 years down the road and get offered a lot of money. They're going to sell to get their money out. Okay, there's a huge payday for them when they sell if everything goes well, but they've got to overcome the hurdle of the preferred. What I like about the straight split, and these deals are hard to find, and it's hard to raise money for them because most people want a preferred return, is 80-20. The general partners are cash flowing immediately on the deal. If the deal is going really well, there's no incentive for them to sell the property because they don't want to get rid of the cash flow. And I think everyone's interests are aligned. And I wish there were more deals that were straight split. But because the preferred return is how investors are more comfortable, then in general, these deals are pretty hard to find. A lot of closed groups that do like 506B deals, and there's not many investors, this is how they handle it. No preferred, let's bring in, say, 20 investors, and we'll give them the 80%. These people bring in $1 million each. They raise a lot of money. They have a very high minimum. And then the other people get the 20. Everyone cash flows day one. There's no reason to sell the property early because everyone is cash flowing. And then waterfalls. This is just when the split's adjusted after better returns. So straight split, it could be we're doing 80-20, but then after, I'd say a 20% return, it goes to a better split for the partners. Okay. So you could also, on the preferred return, you've got an 8% preferred, a 70-30, and then after a 20% return, the split goes from 70-30 to 50-50. It could be the same thing on the straight split. After 20% returns, 50-50. So the partners are generally getting a better deal. They're getting a bonus for performance. The way to look at waterfalls is their performance bonus for the partners if they exceed the metrics that they promised. One thing about waterfalls is if there's too many, it makes the structure really complicated. And you got to get a supercomputer out to figure out what your returns are and how much you're supposed to get paid. So I like deals we have one waterfall to keep it simple. If there's 3 or 4, it's way too complicated to figure out the compensation plan and it's confusing for limited partners and general partners. So waterfall's okay, but don't do too many. There are so many ways to structure these deals. There's a lot of ways to put it together. These are the basic ways that it's put together, and every deal is a little bit different. Okay, typical deal parameters: minimum investment 50,000 is typical. I've done deals where 100,000 minimum is typical. Some closed type deals that are 506B, they have like 500,000 or million, and so they're going after real heavy hitters. I haven't been involved in those deals or participated, obviously, yet, but those deals are out there for people that have been in the game a long time and invest a lot of money, or their family office. 50,000, kind of the standard. Sometimes on a small deal, you'll see less. I've seen some storage deals where they do $25,000, but 50 is kind of the standard right now. Class of shares, there are different classes of shares with different splits and different returns, and it usually depends on how much money you're investing. Okay, if you're investing $1 million, you get a better deal than someone that's investing 50,000. So generally, it'll be 50,000 is Class C, maybe 100,000 be Class B. They're investing more money, and then there'll be a Class A for 500,000 or $1 million, or it depends on the sponsor. If you put more money in, you're going to get a better deal. I've also seen classes of shares that have a high preferred with no upside. So they'll have a 10% preferred return, and then they say, okay, you get a 10% preferred, everyone else gets 7%, but there's no upside. You get paid first, you get your 10% preferred, and then we keep all the rest after the 10%. So the upside can come into the way the class of shares are structured. Length of the business plan, 5 years is typical. Returns can be enhanced, obviously, by early exits. When you're looking at deals, typically 5 years is what you're going to see on a business plan. If you see a business plan that's 3 years, or they say, hey, we're going to definitely exit in 3 years, I think that's a red flag. I think you need to be really careful in those deals. So look for 5 years. But I've seen deals that are 7 years or 10 years. They may show lower returns, like we're going to hold this thing a long time. And I like the long-term thinking, but 5 years is going to be typical. One thing to keep in mind, these investments are not liquid. This is not a savings account. It's not a brokerage account. It's not an IRA. Once you invest in these deals, your money's going to be locked in until they exit, and it could be 5 years. It could even be more, but plan on 5 years. If you want your money back, you're probably not going to get it. I have seen cases where in an emergency, a sponsor will give people their money back and buy their shares. Sometimes the people have to take a haircut. So they put in 100, they're only going to get 80,000 back or less, or they just get the par value that they paid. So they put 100,000 in, the sponsor gives 100,000 out. They're 3 years into the deal. The shares might be worth 150, 200,000 at this point. They're never going to get more than the par. But I've heard of sponsors helping people in emergencies. I've also heard of them getting rid of people that are difficult to deal with and just buying their shares, especially if the deal is going really well and they think the shares are undervalued. If you're having a trouble in a deal and the shares are worth less than par, they're not going to let you out of the deal. So realize these deals aren't liquid. It's better not to even ask, and just be aware of that. Okay, 6 type of debt structures. Debt is very important. Understanding these debt structures is probably one of the most important things in real estate. So let's talk about loans. Agency debt, Fannie Mae, Freddie Mac, fixed rate. This is, in my opinion, the safest type of debt to have on a loan, because Fannie Mae and Freddie Mac really do very strict underwriting. It's difficult to qualify for these loans. They require 90% occupancy for 90 days. The people signing the loan have to be really well qualified. So if you're investing in deals, agency is probably the safest, most preferred type of debt. So I would look for that when you're investing in deals. A HUD loan, a fixed rate, very similar. Department of Housing and Urban Development, they do very long-term loans. They're fixed rates. They're long-term loans. Also in the same category as Fannie Mae, Freddie Mac. They're a little bit less common. A very a safe loan, fixed rate. I don't think they do variable loans in HUD, but it's something to watch out for. I'm not 100% sure about that. Conventional bank loan, typically this is going to be a fixed rate. These are fine. This could be a local bank, could be a regional bank. It's proprietary. The bank is basically guaranteeing their own money. They may have more challenging lending conditions, but they also may work with someone if they like the person or if they've had good luck loaning them money and getting it back. It should be a fixed rate on these in all cases that I'm aware of, but basically make sure that they're getting a fixed rate on a conventional bank loan. Bridge debt. This is a variable rate. This is going to make a deal a lot more risky, in my opinion. We'll talk about risk factors. I'm right now probably not ever going to do any bridge debt or in the near future. Every deal I've seen with problems has had bridge debt. So it's a variable rate. It's basically the select overnight finance rate, I believe is what SOFR stands for. And basically, it's a variable rate. Rate can go up, rate can go down. 2022, they escalated very quickly and a lot of people got in trouble. Bridge debt is nice because you can borrow more money or go back and easily add on to the debt and borrow more money. It can enhance returns, but it also can result in foreclosures and losing money. And it's by far the riskiest type of debt in a first lien position. Mezzanine debt. This is typically a second lien. It's something that's stacked on top of an agency or a HUD or a conventional bank loan. Typically, when you hear mezzanine, just think typical, it's a second lien. They're borrowing more money, may have more leverage. Maybe they can't get all the debt in agency and they got someone that's willing to be in the second lien position. Preferred equity, or as we call it in the business, pref. If you ever saw it say pref, they're not talking about a preferred return. They're talking about preferred equity. It's technically equity, but these investors get paid back first, so it behaves like debt. So the reason to be aware of this is I would not invest in a deal that has preferred equity on it when you're not the preferred equity. Okay. So the way this would work is you've got your loan, the bank is the first in line. Then you've got the preferred equity stacked on top that they're going to get, let's say, a 10% preferred. And maybe they're getting, when the deal exits, they have to have a 15 IRR, or they get all the money up to that. And then your investors, your Class A, Class B, Class C investors are on top of the preferred equity. So the problem is, instead of being second in line to get paid, you're third. So I would stay out of deals with preferred equity. I know people that invest in preferred equity because they're stacked lower than the limited partners. There's certainly nothing wrong with investing in it because you're in line quicker and you have a preferential treatment. A lot of family offices do pref equity, and there's groups that do pref equity to get in deals. Preferred equity is oftentimes used as rescue capital on problem deals. But if you're being presented a deal and they tell you, hey, we're going to get $4,000 in pref equity, that means the people that are, loaning the $4 million, they are in line in front of you, and I would steer away from that deal. So, understand preferred equity and what it means. So on these debt structures, stay away from bridge debt. We're going to talk about that in more detail in future weeks. Look at agency debt, fixed rate, HUD loan, fixed rate, conventional bank loan, fixed rate. Love it. Note all commercial loans have a limited term. All commercial debt has a limited term. Okay, what does that mean? Okay, so on a Fannie Freddie loan, you got a 30-year amortization, but the debt is going to be due in 5, 7, or 10 years. So you always want to go at least 5 years on the debt. I like going out 7. I think it's a sweet spot when you're getting new debt. If you're doing a loan assumption, and you could assume these loans, and people are doing that right now because the rates are lower on assumptions. Someone got a loan back in 2020, the rate could be 3%. That's a great assumption. If you have less than 5 years, look out. So that's where people with bridge debt get in trouble because it's generally a 3-year loan. So look at the term, go for 7 or 10 years, 5 at an absolute minimum. If you're doing an assumption, make sure there's more than 5 years left. When the term is expired on the loan is due, and the lender can call it in regardless of the market conditions. If you have to refinance or sell the property, basically. So this is one thing that's very important. It causes a lot of disruption in the business. Very different than your home loan. You get a 30-year home loan, you got 30 years to pay. You get agency debt. It's 30-year amortization with a 10-year term, and after 10 years, you've got to do something else. Sell the property, you got to refinance, or you got to pay them off. One of the three. Okay, so debt structure, very important. We're going to go in this in more detail later on. This is just the basic debt structures. Okay, fee structures for sponsors. Okay, typical acquisition fee is 2%, very typical. This is common. Sometimes you'll see 3 on a smaller deal. If it's more than 2 on a big deal, like say more than $10 million, I don't like that. So stay around 2%. If it's less, that's okay too, but that could be a red flag. We'll talk about that in a sec. Asset management fees, typically 2%. This is so the sponsors and or their asset management team can manage the property. This is not a property management fee. Third-party property management is something that's totally separate. Sometimes the property manager will be the sponsor, but this is another fee on top of it. 2% is very typical, comes out of the top revenues during the loan. Disposition or refi fee. A refi fee is typically 1%. The sponsor's got to go back and do a loan. It's a hassle to do a loan. They want to get paid for it. If they do a disposition or sell the property, sometimes people will put a 1% fee on the back. I've seen the acquisition fee be 1% and the disposition fee 1%. So it's 2 total. A lot of people have no disposition fee, which I love. You're selling the property, you're going to make your money. There's no disposition fee. Other miscellaneous fees can be stacked any way you can possibly imagine. So you need to ask about the fee structure and what it is and watch out for miscellaneous fees. It's a little bit too much to go over tonight. I don't want to get too in the weeds, but there can be other fees, but these are the typical ones. Red flags on fees, excessive fees. So if the GP plan, their pay plan is all fees, that's a problem. So if there's an acquisition fee and it's 3.5%, asset management's 2%, refi fee 2%, disposition fee 2%, miscellaneous management fee 1%, property management fee 4%, and they're running the property management company. They're being compensated on fees. They're not really caring about how the asset performs. So watch out for excessive fees. Be careful. The other red flag could be no fees or below market fees. If the deal is set up and it looks like the sponsors aren't going to make any money for managing the asset, like an asset management fee or anything like that, or the property management fee, then look out. If they're not making any money while they're managing the fee and there's a preferred return, there's no cash flow, they may lose interest in managing the asset because they're not making any money. They're not getting any cash flow. So watch out for below market fees. Fee structure should be transparent and easy to understand. Ask questions if it's unclear. Always ask questions, understand the fee structure before you invest. Okay, what funds your investment? If it's cash, you're an individual, you can invest as an individual, okay? You can also invest jointly with your spouse. Now, 50, 100,000, you go with your spouse, you're both on the account. Individual could be good for estate planning if you're joint with your spouse. You can also invest as an entity, LLC trust or other entity. It's not a bad idea to invest as an LLC. Is it necessary? No, because all the investors are already within an LLC within the investment. So understand the syndication too. You're buying securities. So in an LLC and the securities laws protect you almost like a shareholder in Apple. It's very hard to get sued as a limited partner. However, investing as an LLC, there's definitely no downside to it. It could be a trust if you have a trust or some other entity, but LLC or trust is more typical. Retirement accounts, can you do them? Yes, but they have to be self-directed. I have a whole video on self-directed IRAs on YouTube you can watch on my channel, which is my name, David R. Priest. But the self-directed IRA or 401k, there's a little bit different rules for self-directed 401ks if you're a general partner, which can be advantageous, but they have to be self-directed. Your typical IRA, you cannot invest in these because they're going to ask you, is it a registered security? In real estate, we don't register securities because it takes 9 months. And we can't go out and buy a property and tell the owners, hey, we can't close for 9 months. We're going to register our security. We get an exemption from registration through the security laws. So we don't have to register them. So you got to have a self-directed IRA or 401k. Excellent way to fund your investment. Although if you can do it cash, it's definitely better. There's definitely advantages to it because you get the depreciation and more of the tax advantages. You can also do a Roth IRA or 401k. If you're going to do a IRA, I really prefer the Roth if you can get there, if you can get to a Roth. It's much better because you don't pay any taxes on the gains. And also when you pull the money out, when you're a little bit older, or if you've reached that age where you can pull the money out, it's tax-free income. So I love Roths. If you have a Roth, you can do it. but it's got to be self-directed, Roth or 401k. Okay, typical investment process. What does this look like? First of all, you got to find the deal. Okay, find the deal, review the documents, review the offering, watch the webinar, review the investment. Wow, this looks good. I like it. I want to figure out more, figure if this fits my requirements. Number two, do research and due diligence. We're going to teach you how to do research and due diligence on these deals and on the sponsors. Everything I'm going to teach you from here on out involves these first two things, 1 and 2, finding the deal, reviewing the investment, doing research, and doing due diligence. Okay, those are the most important things. Once you decide to pull the trigger on a deal, you read and sign the PPM and the subscription documents. This is just the deal flow of the process. You read and sign the PPM. Yes, read the whole thing. It's 135 pages. Make a pot of coffee. It takes time. Read it, understand the deal. If you don't understand the PPM, then ask questions. If you're a 506C, you got to be accredited. They're going to verify your accreditation status. Third-party letter or something in their portal to verify. Sometimes they make you verify before you sign the PPM and subscription docs. Sometimes you'll do that, and then you'll get an email that says, hey, we need your accreditation letter, or you need to go through this third-party website and verify, or you need to go through our portal and verify. There's different ways of doing it. If you're a B, you don't have to verify. One of the best things about being a B is if you're an accredited investor, on a 506B, they'll never ask for an accreditation letter. And I love that. So a lot of people do 506Bs just so like their heavy hitters don't provide accreditation letters. And if you have a high net worth person that's extremely wealthy, it's very annoying for them to go and re-verify themselves. So it's not a good way to go. So a lot of people do the 506B for that reason if they're well established. Now, after you sign the PPM, you verified your accreditation status, the sponsor is going to review those docs. They're going to accept your investment. They're going to countersign the docs, and you get signed docs, and you're ready to go. Now you've got to fund your investment. If it's cash, you just wire the funds to the wiring instructions provided. Now, one note of caution, always verify wiring instructions with a sponsor or with their people before you wire the funds. If you get them on the portal, get them by email, be very careful if something changes at the last minute. Like you're looking at the investment, hey, we're going to sign everything. Here's the wiring instructions. No, we set up a new entity. The wiring instructions change, send the money here. That could be a scam. Be very careful. If they change the wiring instructions at the last minute, something could be wrong. Be careful. They could hack in their email. They could send you the wrong wiring instructions. Just pick up the phone, call the sponsor. Hey, I'm about to wire my $100,000 in. I got the wiring instructions. I got the account number here. The last 4 is XYZ. Is that the right account? Yes. And then wire your money, but verify verbally over the phone before you send in money. If you're in a retirement account, you're going to take the countersigned documents and submit them to the IRA. And then the IRA is going to fund the deal. They're going to wire the money. Okay, so you're going to upload and provide the information to your IRA to fund. Once again, before you upload the information, the wiring instructions, call the sponsor. I'm looking at the wiring instructions here. I'm going to send this to IRA. They're going to fund the deal. Let's verify wiring instructions, because if you send the wrong wiring instructions to your IRA, they may send them out without checking them. And I think most IRAs don't check them. So be careful, check your wiring instructions. I was in the mortgage company 20 years and never happened to me, but I know people that were buyers that sent money to a scam, the wrong bank when they're trying to close on their house and lost their money. I know of a title company that sent the money to the wrong person that was supposed to be the seller, and they lost $300,000. So confirm wiring instructions, please. Check them before you put them in the IRA portal or you provide those. And then now you confirm the funds received. So when you wire your money, it probably will go out the next day, send a wire, have the sponsor confirm your funds received. It's real easy on a wire because your name should be on it, on the notes. It should be easy to confirm. On an IRA, it's much more difficult. The IRA company may take a week, and when they wire their money in, guess what? They don't put the IRA account number. They don't put the person's name on it. They just send the money, and the sponsor may have 40 wires from one major IRA company and not know what's what. And they got to call the IRA company and confirm them. So that process may take longer. Don't panic. It just takes more time to sort out. But if you're doing a regular wire, it should be very easy to verify. It may take a while on an IRA to verify where it's from and who it's for. And if the sponsor needs you to call your IRA company and confirm when the wire was sent and what the Fed reference number is, help them out. It's very confusing because these IRA companies do not put that information on the wire they send out. Now you've got the funds received. Now monitor the deal. Make sure what's going on. Make sure it closes. The deal doesn't close and it blows out. Guess what? They got to send all the money back to everybody. They got to send everybody's money back. So monitor the deal, see if it closes. A kind of a pro tip on this is don't be afraid of backfilling. So if the deal's already closed and they're still raising money for CapEx or for reserves, those deals are great to jump on because there's already deals that closed. There's no risk. There's no changes. And you getting in later, you may get a better return because you're closer to an exit. Okay, so that's what I have for tonight. Wow, that was a lot of information.